A toxic investor can destroy your business. A common mistake founders make in startupland is that the worst that can happen is that an investor puts in money and does nothing else. They walk away. They don't add value or anything else. But it can be worse. And I want to illustrate this with a story. I was on a board once, and some of my co-investors, when it came time to make a difficult decision on the future of the business, they prioritized a little bit of a marginal improvement in their returns than the potential long-term value of the company itself. And this is actually quite common and one of the many types of decisions that a toxic investor will make, pursuing their own limited interest rather than the interest of all the other shareholders. In this video, I'm going to go through 10 signs that you may be dealing with a toxic investor before they put in any money, so you know what to look out for and who to avoid. My name is Matan Hazanov. I've been in venture capital for about 10 years. I've been involved in over 50 startups, deployed tens of millions of dollars, help companies get to 9-figure valuations. And I want to make it clear, I'm not talking about the classical agency problem where the interests of management may conflict with the interest of shareholders, which is very common and actually presents a very interesting ethical, philosophical, and sometimes legal challenge to any investor that represents ownership where their interests may conflict with the other owners and management. And here's what to look out for in a potential toxic investor. The first sign you may be dealing with a toxic investor is if they're taking way too much time conducting their due diligence. What this may tell me and you is that they don't have a clear vision, mandate, or perspective on what they want to invest in. And they may be taking an extra long time to wait until you have a low cash balance to extract the best deal possible. The second sign you may be dealing with a toxic investor is that they charge you fees. Let me be absolutely clear. No credible VC will charge you a fee to invest in you. Some accelerators and incubators may do this, which is fine. That's part of their business model. But a typical VC will not and should not charge you any fees, not in kind, not directly out of the deal itself, none of that. The most common types of fees you'll see in a term sheet is paying for legal expenses and maybe some due diligence costs. That's it. Anything else, run for the hills. The third sign is that they ask for many non-market terms in their term sheet. And what is non-market? That's a great question. See some of the other videos on this platform or check out my blog to figure out what is considered typical terms you'll find in a VC term sheet. But if it deviates from that a little bit, it's always good to get advice either from a VC with a lot of experience that you trust, a lawyer, a friend, another founder who has done this before. This will actually change by geography and by industry. So make sure to double check with someone that understands your industry, your stage, and your geography to get proper advice on what's considered market. But if they're asking for some crazy stuff that's clear to everyone is not normal or standard, you may be dealing with a toxic investor. The fourth sign is that they constantly change deal terms with very poor justifications. It's normal and expected that if things are discovered in diligence, the investor can reasonably ask for changes to the deal terms if they make sense and are connected to what they discovered. But if the investor is continuously asking for changes to the terms all the way till closing with poor justifications, this is a sign of how they operate in business in general. And I know that when founders are getting to the end of the line, when they're about to close a deal, they're at their most desperate and vulnerable state. And many investors know this, and they know the best time to ask for a change in terms is very near closing because the startup is often relying on that capital to survive. This type of investor is toxic. The other sign, and this is an obvious one, is that they're reluctant to offer references to companies in their portfolio. So two things can happen in this case. One, they don't have actual other investments, which is a red flag in and of itself. And the other is they have bad references and can't share any because they want to get the deal and they don't want you to figure out that they're a toxic investor. One of the first things you should do for any investor when you sign a term sheet with them is to ask for references from their portfolio companies. In fact, you don't have to ask even. Go look at their website, see who they've invested in, and go reach out to those founders. And most founders will be happy to speak with you If they really dislike the investor, they'll be happy to speak with you, and if they love them as well. The sixth sign you may be dealing with a toxic investor is if they don't have a track record of working with other VCs or other investors that invest in something similar to them. Now, in venture capital land, we call it co-opetition. People compete, of course, for deals, but they also like to cooperate. The more money and the more talent and knowledge you have around the table, the better it is for you. The investment is safer. So what you want to see is that these people can work well together with colleagues and peers in their industry to make investments. If they can't, and if they don't, that's a red flag. The seventh sign is that they don't have a committed pool of capital, otherwise known as a fund. Now, if they go out and raise for each deal from a group of their investors, there's two significant issues with this. The first is they may not be able to close. You want to know if they sign the term sheet and everything goes well, that they can close the deal. The second issue, and probably the greater of the two, is that they may not make decisions in the best interest of the long-term value creation of your business. Let me explain. If you come to a difficult crossroads in your business, which happens very frequently, do you take a risk and grow more, or do you sell for a low price today if you get an acquisition offer? You have to understand that the interest of this particular investor will not necessarily be for the long-term value creation of the business, but rather, if they get a little bit spooked, to return money to their investors. Because on their side, if they have investors only invested in one company, a single loss can be devastating for their reputation. When an investor, a VC, has a fund, they can take those risks because they know that some of the companies in the portfolio will fail, and that would not necessarily impact their reputation because they have a whole portfolio of investments. This is very important and key, and most people don't think about this. So make sure that if you're taking money from an investor, that they already have a fund in place. And the only exception to this, in my opinion, is a corporate venture capital group, which is likely investing off the balance sheet of the parent corporation. The eighth sign is that they've rebranded multiple times, and this is obvious because if they've rebranded multiple times, it's probably because they have a bad reputation and are trying to hide it. The ninth sign, and this is a fun one, is that they have a big ego, and not just a typical big ego expected of most VCs. No, this goes beyond the typical VC and shows up in everything they do. They show up late to meetings, they're not respectful of your time, they think that they're smarter than everyone, they're not curious, they try to give you advice no matter what you think. They'll always tell you that they think they're right in some capacity or another. There are many ways to figure out if a VC has a big ego, more so than normal, and this kind of person will be very difficult to work with on a board, so much so you should avoid them like the plague. And the 10th sign that you may be dealing with a toxic VC is that you don't like them. You meet up with them and you just don't click. And I think that intuition that you have as a founder and as an entrepreneur is actually pretty critical. You want to be able to work with someone. These people are going to join you as a partner in their business, and you actually have to like working with them. This sounds obvious, but it will be shocking for you to know how many founders don't consider this as a factor when they're deciding who should join their board and become a partner in their business because they need the cash. But I'm telling you that if you bring people onto your board you don't like or who are toxic investors, it will create more problems for you down the road. So, in conclusion, flip the script. Don't just allow the investors to do their diligence on you. You have to do your due diligence on the potential investors, because if you bring on a toxic investor into your business and make them a partner, give them positions on your board, give them rights to decide your budgets, your strategy, who you hire, how you hire, you can irreparably harm your business. Even if you need the money, it's better not getting into a partnership with a toxic investor and trying to find an alternative solution to your financial problems. Trust me, I've seen this happen and I've seen it destroy many startups. That's it for this video. Thank you so much for listening. If you like this type of content, please leave a like, subscribe, leave a comment below, let me know what you think, and I'll see you in the next one.